Because Trump offered Iran a 5-day reprieve on the Strait of Hormuz, Brent crude fell 10.4% in a single session, and that single shift in oil expectations was enough to send the ASX 200 up 1.3% after 3 consecutive days of losses. The mechanism was direct. Oil above $100 had forced central bank watchers to price in more aggressive rate hikes, weighing on rate-sensitive equities. When Brent dropped back to US $100.48 per barrel from a peak near US $120 the prior week, that inflation premium was partially unwound. The result was a split market. The ASX Energy Index fell 2.7% as Woodside dropped 3.5% and Santos gave back 3%, while the ASX All Ordinaries Gold Index surged 5.1% and VHP jumped 3.7%. The same oil signal that crushed energy stocks became a tailwind for miners and tech, because lower oil reduces input costs and softens the case for further rate rises. The Australia-EU trade deal, signed after years of negotiations, adds a separate structural dimension. The framing from Australian officials was pointed, that both sides must get China right to make the partnership work. This positions the deal less as a purely economic event and more as a geopolitical hedge, a backstop trade relationship for both parties if Chinese market access deteriorates further. For Australian miners and agricultural exporters, the deal opens new channels. But the China dependency remains, and how Beijing responds to a more integrated Australia-EU axis will determine how much of this potential materializes. Meanwhile, consumer confidence fell to its lowest level since records began in 1973, below readings hit during the COVID lockdowns. The mechanism compressing sentiment is a cost-of-living vice. Fuel shortages, oil-driven price rises, and rate hike expectations are hitting simultaneously. With Treasurer Jim Chalmers preparing a May budget that includes tax reform, the drop in confidence raises the political and economic cost of any measures that add near-term household pressure. Employers have already signaled what they see as a ceiling. The Australian Chamber of Commerce backed a 3.5% minimum wage rise aligned with CPI, warning that anything above inflation risks making the economy unsustainable. The union's demand for more is, according to the Australian, a recipe for severe pain.
Away from the macro headlines, structural stress is building in copper smelting in ways that matter for ASX miners. Treatment and refining charges, the fees miners pay smelters to process ore, have collapsed from US $80 per ton in 2024 to effectively zero or negative in spot markets. Copper itself trades near US $5.50 per pound, up 7.7% year-on-year. But the processing bottleneck means miners increasingly face a binary choice: accept concentrated smelting power in fewer, mostly Chinese hands, or absorb the cost of securing alternative routes. Capstone Copper, the ASX-listed copper producer trading near $10.25, sits in this crossfire. Strong long-term demand from electrification, but short-term structural uncertainty in midstream processing. If smelter concentration rises further while treatment charges stay negative, the bargaining dynamic between miners and processors could shift permanently. 3 signals to watch. First, whether Brent holds below $100. If the Iran reprieve leads to genuine Hormuz reopening, the inflation rate hike feedback loop that crushed sentiment could ease materially. If talks collapse, oil spikes and the ASX's Tuesday gains reverse. Second, the May federal budget. With consumer confidence at a 53-year low, any tax reform that front-loads household costs risks tipping spending contraction into something deeper. Third, copper smelter dynamics. If byproduct credits in China soften as they did in 2024, Chinese smelters lose their buffer, closures accelerate, and miners gain back pricing power. If subsidies hold, the concentration risk for Australian copper producers only deepens.